Disclaimer: stock trading is inherently risky and the users agree to assume complete and full responsibility for the outcomes of all trading decisions that they make, including but not limited to loss of capital. Matthew, chapter 25 verse 14-30, "For it will be like a man going on a journey, who called his servants and entrusted to them his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money." For today's video, we are going to talk about regret theory. Key takeaways. Regret theory is about how people act because they are afraid of regret, which comes from the fact that they know they will feel bad if they make the wrong choice. By simplifying the process of investing, buyers don't have to worry as much about making bad choices. The regret theory has an effect on investors because it can make them too risk-averse or make them want to take chances they shouldn't. The regret theory says that people expect to feel bad if they make a bad decision, and they take this into account when making choices. Fear of guilt can be a big reason why someone doesn't do something or why someone does something. Regret theory can make an investor act less rationally, making it harder for them to make investments that will help them instead of hurt them. When it comes to spending, the regret theory can either make people afraid to take risks or push them to take more chances. For example, let's say an investor gets shares in a small company that is growing because a friend told them to. After 6 months, the stock price drops to 50% of what it was when the investor bought it. The investor then sells the company at a loss. The trader could avoid this sorrow in the future by asking questions and doing study on any stocks that the friend suggests. Or, the owner could decide to never take any business advice from this friend seriously, no matter how good the advice is. Conversely, suppose the investor didn't take the friend's recommendation to buy the stock, and the price increased by 50%. To avoid the regret of missing out, the investor could become less risk-averse and might likely buy any stocks that this friend recommends in the future without conducting any background research. In trading, regret theory and the fear of missing out, also known as FOMO, are often linked. This is especially clear when bull markets last for a long time, when the prices of financial products go up and investors stay optimistic. Even the most cautious and risk-averse trader can miss signs of an approaching crash because they don't want to miss out on a chance to make money. Alan Greenspan, the former head of the Federal Reserve, widely used the term irrational exuberance to describe investors who are too excited about an asset and drive up its price beyond what the asset's facts can explain. This unrealistic hope about the economy can lead to a habit of investing that keeps on going. Investors start to think that the recent rise in prices is a sign of the future, so they keep putting a lot of money into the market. Asset booms form, which eventually burst and cause a rush to sell. If this happens, the economy could go into a deep slowdown or crisis. The 1929 stock market crash, the 1987 stock market crash, the dot-com crash of 2001, and the financial crisis of 2007-08 are all examples of this. Investors can reduce their fear of regret from making incorrect investment decisions by automating the investment process. A strategy like formula investing, which strictly follows prescribed rules for making investments, removes most of the decision-making process about what to buy, when to buy, and how much to buy. Investors can use programs to handle and carry out their trades and automate their trading methods. Using trade tactics based on rules makes it less likely that an investor will make a choice based on how an earlier purchase turned out. Investors can also try their automatic trade methods in the past, which could show them where they made mistakes because of their own biases when they made their investment rules. Robo-managers have become more popular with some investors because they allow automated trading and are cheaper than traditional advisors.
That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also follow us on our Facebook page to learn more about the stock market.